Dr. Montek Singh Ahluwalia, Deputy Chairman of Planning Commission, joins us live from New Delhi. Dr. Ahluwalia, good morning and fantastic to have you back. First, my compliments in last 24 hours, in last 48 hours, the regulator, government, everyone has come together and they're trying to fix the rupee, they're trying to fix the economy. And I guess secretly markets are also acknowledging that, then now they are also rewarding that. But let's first talk about the big policy reform which was announced yesterday. FDI in key sectors has been increased. And I think the intention here is very clear, sir. The intention is to attract dollars. But the problem here is that even though FDI floodgates have been opened, do you think because of the climate in the near term, flows or FDI money will not come in?
Well, let me just clarify, the initiatives taken yesterday were very important policy initiatives in a broad direction that we've always indicated. But I think it would be wrong to regard them as designed to create a greater inflow in the short run. I mean, it might happen in some sectors. I mean, this is really a continuation of the policy that India is open to foreign direct investment, and we're getting rid of what we regard as unnecessary hindrances. I don't expect that when you do that, short-term need for money in the next 3 months or 4 months would be significantly impacted by these measures. Yes, in some sectors where people have been waiting for these limits to be raised, there may be some impact. But the scale of that is not going to be comparable to what we actually need to do in order to manage the current account deficit in the short run. That doesn't mean they're not important. Because, in many of these sectors, when you give a signal that investment is open, investors then start thinking about it, they try to get the details, they work out the business deals that are possible, and they also look to the international environment. So the response to these measures is going to be there, but it's going to be stretched out over a period of time. I don't think you should describe this as an effort to get dollars. I mean, whatever dollars flow in are welcome. But this is not what we are trying to do in order to manage the current account deficit in the short run.
But do you see political opposition to the FDI move, Dr. Ahluwalia, especially when it comes to defense and insurance? Because after all, the parliamentary panel was in favor of retaining FDI for insurance at only 26%.
Well, the insurance move is not something that's going to be done until the bill is passed. There's some confusion in the newspaper reporting. I mean, my understanding is that we intend to raise it from 26 to 49. A bill is pending, and it's only when that bill is passed that this will be brought into effect. So it's like a re-endorsement of the government's intention. But if there's political opposition, then the bill won't be passed. So the insurance issue is not something that should be controversial. We should just wait and see what Parliament does. As far as defense is concerned, that has really implicitly always been the policy. That is, it's 26%, but you can always to make an exception, you would have to go to the Cabinet Committee on Security. What I think the government has now signaled is that it is open to consider investments in defense industries beyond 26% because there already exists a mechanism where an exception can be made, and that's the Cabinet Committee on Security. But I think what the government has signaled is that where high technology or state-of-the-art technology in defense is involved, it is open to consider such possibilities. So we have to see what the reaction is going to be. I mean, I do regard it as an important signal for the future. Again, it's not something to which anyone is going to respond in the next 6 weeks or 6 months. Or frankly, even if they do respond in the next 6 months, I don't think the actual FDI will come in less than 2 years' time. But it's a very, very important signal.
Right. Mr. Ahluwalia, often when I've interacted with foreign investors, they are of the view that we want to come to India, but there are a lot of hurdles, there are a lot of clearances, there is a, coming to India is a huge time-consuming process and something which often has really, forced us to rethink our investments. How exactly is government planning to really, to clean up that act?
Oh, I think that's actually extremely important. And let me say that this is not just a problem that faces foreign investors. I believe that the hassles, the delays, the difficulty in getting clearances are not greater for foreign investors than they are for domestic investors, and we should definitely reduce them for both. The difference, I think, is that foreign investors are not used to these kind of hassles, and therefore they tend to be a little more hesitant about it. Now, against this, they have to balance the advantages of access to a very large market. I mean, it's very unlikely that anyone would come to India if they were not interested in the Indian market and solely interested in, if you like, servicing a global market. For that, you really need to have very, very easy access, and quite frankly, we've done that in things like software, etc., where basically these hassle problems are much, much lower. People come into India because they realize it's a very large market, and more importantly, it's a growing market. I mean, if you believe that India is, on the medium term, I'm not talking about the current year. The current year doesn't look all that exciting, perhaps, anywhere in the world. But in the medium term, if you think this is an economy going to grow at 7 to 8%, and if you think that by 2030, it's going to be the third largest GDP in the world, what foreign investors have to ask is, isn't it worth getting in there? I agree that the initial hassles are too much. But I think if companies that take a longer view and overcome these hassles, operating in India is much less difficult than it seems when you're just thinking of getting in. But I'm not making an excuse. I think the ease of doing business is not at all what it should be in India. It's too poor, and that's true because of a set of policies. Some of them are central government policies, some of them are state government policies. You know, at least half the permissions needed from the point of view of ease of doing business are permissions that are given by state governments. And, you know, in the 12th plan, we've emphasized this, that we really need to tackle this part of the problem. And the interesting thing is, states don't have to wait for consensus at the national level. So different states can take different steps in order to accelerate whatever they're going to do. And I would really urge our state governments to adopt a very competitive approach from this point of view. Whichever state government improves the ease of doing business in that state will find a flood of investment, not just foreign investment, but also domestic investment going into that state.
So, Mr. Ahluwalia, I mean, what is the government doing when it comes to narrowing the current account deficit? Because that clearly seems to be the biggest stain and blotch on our cloth.
Yes, that's absolutely correct. You know, last year, that's 2012, 2013, the current account deficit shot up to about 4.7% of GDP, according to the latest estimate. And that's far too high. And we had expected it to be high and had said that it needs to be brought down. I've no doubt that this year is going to be substantially lower. I don't have a number, but I would expect it to be well below 4%. Now, the reason for that, last year's big increase was due to an absolute explosion in the import of gold. Probably a reflection at that time that maybe the rupee was a bit weak, maybe the rupee would depreciate, and also at that time the perception that internationally gold prices were going up and that gold would basically be a very good investment. Now, I think those things have changed. I mean, first of all, the rupee has already depreciated, and I don't think it would be reasonable to expect, now that it's reached a much more competitive level, that further depreciation is really likely. And what the Reserve Bank did yesterday, the day before, was actually to indicate that it is willing to put in place policies which send the market a clear signal that we think that the currency has been a bit over depreciated. I think the markets have responded to that reasonably well. Gold prices internationally are not going up, actually they fell. So my expectation is that in the current year, you will have a lot, maybe 1 percentage point of GDP less, could be on account of gold alone. If gold were to return to normal levels, that's what would happen. Now, in addition to that, the economy is obviously a little on the slow side. I don't think we're going to get a big increase in oil prices. So I expect that in dollar terms at least, the oil prices will be more or less stable. And other commodity prices will also be roughly stable, if anything, a bit on the soft side. because growth everywhere has slowed down. Now, for all these reasons, I think the current account deficit is going to be much lower than it was last year. It will still need to be financed. But you know, last year we were able to absorb, I forget the exact number, but something of the order of $92 billion as a net capital inflow. Some equity, some FII, some borrowing, and so on. Now, we don't need anything like that amount. So the question is, internationally liquidity is tight. India will not be requiring nearly as much liquidity as we did last year. And we have a pretty large stock of reserves. So if there is some little shortfall in the foreign exchange requirement to finance the current account deficit, the Reserve Bank always has the option of relying on the reserves that have been built up as a short-term measure. Looking long-term, there's no question in my mind the current account deficit has to be brought down maybe to 2.5%. Now, you know, other than the monetary measures, the key thing is fiscal. And I think the finance minister has said many times, both at home and abroad, that he regards the 4.8% fiscal deficit as a sort of a red line. He's not going to cross that. Well, you know, that is what markets are looking for. We're not going to be fiscally profligate, and over the coming years, the fiscal deficit should be brought down even further. I mean, those are the key elements of a macroeconomic strategy to manage and finance a reasonable current account deficit.
Mr. Ahluwalia, don't you think crude as well is a bigger wild card, so to speak, to the assumptions that you just talked about? And because of the growing tensions in West Asia right now, we may see the economy as well as the currency again get into the vicious cycle.
Well, you know, every outcome is normally distributed around a mean. So I think you should certainly assume that there is a 2% chance that crude prices will shoot up, but there's probably a 2% chance that they'll shoot down. I'm really looking at the mean outcome. Obviously, if there is a major breakout of crises and all the rest of it somewhere, I mean, all bets are off, not just for India, but the whole world. So I think policy should not be made on the assumption that there may be a crisis. Therefore, let's not assume anything about normalcy. If there's a crisis, we'll have to deal with it.
Right, with shale gas and China slowing down, obviously the constructive argument for crude is not all that bullish. But Mr. Ahluwalia, Reserve Bank of India, in order to stem the rupee or curb the rupee volatility, like the finance minister yesterday put it out, they have decided to compromise on growth. Is that a right move, that you're getting stability in rupee at the cost of growth?
No, I didn't hear the finance minister say that, by the way. It's not as if everything you do is at the cost of growth. I mean, I think we must understand that the notion that by not stabilizing the rupee, growth would not be affected is fundamentally wrong. Because, you know, if all that the rupee did was to make exports more attractive and imports more expensive, then of course you could argue that case. But rupee depreciation has negative effects on balance sheets. And I think the negative effects of excessive currency volatility on balance sheets can have a hugely negative effect on growth. So the idea that restoring stability in the currency is not necessary for growth is quite wrong. Now the issue really is, did the RBI do the right thing? I believe, I mean, I've described it as it's a classic interest rate defense of the rupee. You've had a change in global situations. The interest rate margin for funds to come into India narrowed very sharply. The RBI has actually countered that effect a little bit by preventing people at the short end of the market, preventing people from speculating against a rupee depreciation. Now, our view, and I think the RBI has clarified it, banks have clarified it, this by itself will not affect long-term rates. From the growth point of view, what really matters is availability of funds and the rate of interest at the longer end. I think what the RBI has done is a short-term measure. My guess is that what the RBI is counting on is that in another few weeks or so, markets will realize that a lot of the uncertainty that caused this speculative fever will have subsided, and it's quite possible that they'll then be able to reverse these moves. We need to do a lot of other things for growth. I think what growth is held up for right now is not tweaking of the monetary policy. It's held up because a lot of large projects in which money has been invested, in which bank money is tied up, in which there are investors there who would like the project to move forward, these projects are held up for one or other kind of regulatory clearance. Now, I think the government has to get into the act, and it is getting into the act. And that's why the Cabinet Committee on Investment was set up. So I think if that committee, it has already met several times, it has taken a number of decisions. These are filtering down. I think we need to continue doing that. And I think in another couple of months, people will get a cumulative sense of what the impact of this process is. At the moment, in my view, a lot of decisions have been taken. I think they're beginning to filter down. But the public, or even the investor community at large, doesn't really know that these decisions are really going to be implemented. You know, it's like you decide on coal supply, you decide that domestic supply is so much, import so much, but then people wonder whether when the fuel supply agreement is drafted, will it have all the right elements in it? Are the fuel supply agreements actually being signed? So I think, you know, when investors are spooked, they're no longer impressed by simply making a decision. They want to see at the end of it, will enough power producers get up and say, yes, my fuel supply problems have now been satisfactorily resolved. And I hope that that message is going through already, and it certainly should go through big time in the next couple of months.
But Mr. Ahluwalia, I mean, don't you think the to and fro that we've seen on the Jet Etihad deal, situations like these send out a wrong signal to the foreign investor? And what is the government really doing about to take a corrective step?
No, you're referring to the Jet... I missed what you said. Which deal are you referring to?
I'm talking about the Jet Etihad deal, Mr. Ahluwalia, and the kind of to and fro that we've seen and the kind of wrong signal it really sends out.
Let's be clear about it. I mean, there are certain areas where the policy is completely open, and there are certain areas where there are conditions put down. In this particular case, the condition is that the ownership, the control of management should rest with the Indian company. Now, you know, whenever you have such a condition, there has to be a check on whether the investment is consistent with that condition or not, and whether the investment is consistent with other regulatory approvals or not. So what has happened is that there was some question over whether the shareholders' agreement that was entered into was negating the concept of control remaining in Indian hands. And I think it's not surprising that those things have to be sorted out. It only sends out wrong signals if you don't take these conditions seriously. If you take these conditions seriously, you inevitably have to go back to the regulatory body and say, look, this is the arrangement, and the regulatory body says, you know, but this isn't quite right, and you have a little bit of a negotiation to set it right. So these are areas where entry is not completely open. Entry is subject to certain conditions, and inevitably, whoever is giving the permission has to do the due diligence to make sure that those conditions are observed.
Mr. Ahluwalia, so given the kind of macros we are working with, where rupee has moved and the kind of GDP data we've got last week, do you think a 6% GDP growth for FY14 will come with some riders, or you're confident of and certain that this year we will get a 6% GDP growth print?
Well, I mean, the most important signal that the government has given, I believe I've seen the finance minister being quoted as saying about 6%. I think what he's really saying is that at the time of the budget, we had hoped that the growth rate would be 6.5%. He's actually saying that that is not our expectation. It's going to be lower. Now, will it be 6%? I think the finance ministry at some point will put before Parliament its revised estimates for the macro picture, and probably they'll go into details. Ideally, one would like to see the growth rate of the first quarter before making an estimate. It's quite clear that we will be significantly below 6.5. Whether we can reach 6 or may fall a little short, I think one has to keep a little bit of an open mind. You know, there are a lot of international observers who are also making growth forecasts. And I think in India, we tend to focus as if we are the whole world. Now, population-wise, we may be a very large part of the world, but GDP-wise, we're not. So I think it's very important to keep in mind what's happening globally. Now, about a week ago, the IMF put forward its update on the global economic outlook. They've actually reduced the projected growth rate compared to what they themselves had put forward in April. In other words, in the last 3 months, they've reduced the growth rate projection by something like a quarter, or in some cases 0.5%. Many forecasters for India have said the growth rate will be somewhere around 5.7 or so. Now, which is still above 5.5, but it's not up to 6. You know, I think that it's not really worthwhile pitching all your skills on a number, because that, frankly, requires, you need to keep revising that estimate. The most important question is, will India do better than last year? I believe that every forecast that I've seen suggests that India is going to do better. I think we have to work very hard to make that happen. But if all the things that we are doing, particularly through the Cabinet Committee on Investment, actually work, and we come up with a growth rate somewhere, if not 6, as close to 6 as possible, so that people can say, well, India's turned around. It was 5% last year, it's somewhere between 5 and 6, and hopefully closer to 6 this year. That will be a very positive signal. I think the fear right now, or if you like, the negativity, is because of the perception that maybe we're accepting 5% growth as normal. We're not. And you know, whether we get to 5.7 or actually reach 6, I mean, that's interesting. But the important point is, if we get somewhere there, most people will believe that the worst is well behind us, and next year we could even go close to 7. So I would look at the important question in the current year is the economy categorically going to show a turnaround? I think it will, but let's see what happens.
Mr. Ahluwalia, one final question from my end. Most people do believe, or rather have zero hopes of any rate cuts in all of the fiscal. Are you of that opinion as well, or do you think that the RBI's moves for tightening are just short-term in nature and we may see some rate easing in the second half of the fiscal?
Well, you know, I don't want to forecast whether they can ease the rate in the fiscal later in the year. I mean, look, the most important thing is we should not read from the current short-term measures that the possibility of easing later in the year disappears. This is a short-term measure. And if markets stabilize and everybody sends around the signal that the rupee at its present level is reasonably okay. I mean, it can always bump up and down a little bit depending on market conditions, but broadly it's okay. Then I think the RBI should look at the underlying fundamentals before deciding on the long term what it does on the policy rate. And those underlying fundamentals would really be crucially connected with what's happening to the current account deficit and secondly, what's happening to inflation, actually to both things. You know, a current account deficit could be high but being financed, and you could still feel that, you know, it's a little too high, so let's not stimulate growth too much, because although it's being financed now, maybe you're vulnerable. That's one issue. So I think if they find that the current account deficit is getting squeezed, which I think they will find, then that's a good sign. And if they find that inflation is not ticking up, remains in the comfort zone. There's certainly a WPI inflation of around 5% or even below at the moment is in the comfort zone. And if the consumer price index comes down, you know, which it could, if we're getting rid of stocks. I think Cabinet had earlier approved that the FDI would be getting rid of excess stocks of wheat and rice. I think they've put out tenders to do that. If the monsoon is good, which at the moment it looks good, so on the food side we don't have a problem. Later in the year, the RBI could take a view that, you know, the macro fundamentals now warrant easing. That is not at all ruled out by what they've done right now. I mean, what they've done right now is really a short-term measure. But I wouldn't predict what they will do later, because it depends on these other things.